Hello and welcome to our bi-weekly Understanding Markets video update. We're recording this on the afternoon of Tuesday, the 31st of May. I'm Hellen Dalton, a Senior Investment Manager here at Cantor Fitzgerald. And today I'm joined by our distinguished Chief Investment Officer, David Beaton. Hello, David.
Hello, Helen.
So, David, was it my imagination or did markets manage to finish up last week?
Yes, no, it wasn't a figment of your imagination, Helen. Markets did actually put in a very strong performance last week, their best performance since March this year, since after the invasion by Russia into Ukraine. I mean, the Nasdaq rallied by almost 7% last week. We saw mid-single gains for the Dow and the S&P. European markets also put in gains of about 3.5%. So yes, it was a much more encouraging performance by markets last week. There was a number of things that really propelled this move higher during the course of the last week. We saw some less hawkish, I wouldn't say dovish, but less hawkish comments coming out from the US Federal Reserve. One member in particular, the Raphael Bostic, who is the Fed governor of Atlanta, he suggested that while the Federal Reserve would increase interest rates by 50 basis points at the upcoming June and July meetings, he felt it would then be warranted to stand back and for the Fed to assess incoming data before determining the future pace of interest rate increases during the second half of the year. So that brought down expectations within the market of how aggressive the Fed are likely to be in 2022 on their rate dynamics. Previously, markets had been penciling in probably interest rates of about 3% by the end of the year. They've pulled that back in a little bit to probably targeting a rate of about 2.7%. And indeed for 2023, where the market had been anticipating 3 interest rate increases by the US Federal Reserve, they're now only expecting 1. So that helped keep bond yields contained. It gave good support for the Nasdaq in particular, which has been a significant underperformer year to date. And helped convey a bit more confidence within the market. We also saw some moderation in some of the key data points that the US Federal Reserve look at, particularly the US core PCE, which is their preferred measure of inflation. It measures the pace of income and expenditure or spending within the US economy. And that came in slightly lower than expected. So again, adding to this kind of belief that the Fed won't have to be as aggressive in their rate increases because the data points will start to moderate as we move into the second half of the year.
And any news out of China? Are they easing or where are they at the moment?
Yeah, well, the Chinese situation has improved over the course of the last week as well. We did see a couple of interest rate cuts in a couple of key lending areas of the market in mortgages and in 5-year bank lending by the People's Bank of China. And that was consistent with the message that's been communicated by both the government there and the PBOC that they were going to take whatever measures they need to try and stimulate the economy which has weakened as a result of the zero COVID policy deployed within China. And in that regard, we saw the big lockdown in Shanghai, the key manufacturing region within China. And we got news over the weekend that they're likely to remove all those restrictions by the middle of this week. So again, that gave markets a bit of a push yesterday, even though the US markets were closed for the Memorial Day holiday.
And of course, you've mentioned Nasdaq already. That's predominantly tech. So what does this mean for the outlook for tech? I mean, it's been absolutely hammered this year.
Well, I think we've mentioned it previously, and our colleagues in Merian Investment Managers on their similar type of podcasts and videos have highlighted that the structural leaders in the technology space, the likes of your Apples, your Amazons, your semiconductor stocks, have severely derated as a result of this sell-off in the market. They still remain the leaders in their sectors. They still retain a significant amount of cash on their balance sheets. And structurally going forward, we think these names look very attractive. At these levels, as I said, they've experienced quite a pullback. And last week, we did see some buying of those names that had been severely sold off. The likes of Alphabet and Amazon had fallen significantly the week before, and some disappointing news out of Snap and out of Facebook previously. But we saw strong buying of those names last week.
Okay, that is useful to know. And of course, we've had the US retail reporting season. Anything there that jumped out at you?
Yeah, well, I mean, this time 2 weeks ago when we were doing this video, we were commenting on the fact that both Walmart and Target had produced very disappointing results. Well, sorry, the results were actually in line, but it was their guidance, which was disappointing in relation to how they were handling supply chain issues. They had overstocked, they were overstaffed, they were having problems on their distribution areas. And that kind of set a bad tone for the retail sector reporting season, which traditionally concludes the first quarter reporting season. But in fact, since both Walmart and Target reported, we've seen very strong results and much more positive commentary coming out from other retailers in the States. So that also helped support markets last week.
And I guess that might make the job for the Fed even harder than it already had been up to this point. Has there been much movement there? What's the word from the Fed?
Well, the Fed don't comment specifically on individual data points or sector performance. I think the critical thing to bear in mind in relation to the Fed and tying it into the price action we've seen in markets this year, where we've seen the Nasdaq down about 17 or 18%. It's well off its low, but other markets in the US down about 7.5%. That financial conditions, which is what the Fed are trying to do, is tighten financial conditions to try and take some of the excess liquidity out of the market. This move lower in markets has essentially done some of that for the Fed. Bond yields have gone up, although they have come back off their peaks. But we'll touch on bond yields again in a moment. Corporate credit spreads have also become wider as well. So refinancing and issuing of debt becomes a bit more expensive. So we're not seeing the same level of issuance in debt markets as we had previously. So that's kind of sucking out some of the excess liquidity within the market. And that's exactly what the Fed is trying to achieve.
What about Europe? So we've had some EU inflation figures out today, and we've also had news of new sanctions against Russia. Where does that leave us? I mean, is there any comments on that?
Well, I think I'll touch on Europe and the ECB first, and then maybe expand it into kind of the impact for broader markets, given the rally we had last week. I think if you look at the ECB, they've been very slow in admitting that inflation was going to be transitory. So we had Philip Lane out yesterday basically confirming what the market had already kind of priced in, that you're going to get a 25 basis point increase in the July and September meeting of the ECB. That would concur with what Christine Lagarde said in a blog last week, that negative deposit rates or interest rates in Europe would be gone by the end of the third quarter this year. If you remember that the deposit rate at which banks lend to our deposit money with the ECB is at minus 50 basis points. So essentially, they're going to wipe that out and bring rates back to zero. Troublingly for the ECB, we did get very strong inflation data out of Germany and Spain yesterday, and we got a record high in inflation, or sorry, a multi-decade high in Eurozone headline inflation this morning. Now, critically, the core rate remained unchanged at 3.8%, but that's still nearly double the 2% target that the ECB have. So, we are facing the issue of tighter monetary conditions in Europe, and then again overnight, adding to the inflation fears, we saw the move by the EU imposing the ban on the import of seaborne oil and gas, seaborne oil and other petroleum products from Russia. So oil has moved higher today. Brent crude is at about $124. So that's keeping the inflation narrative bubbling bubbling up under the surface. And the reaction we've seen today is bond yields in Europe have moved out quite aggressively. We're back up over 1.1% on the German 10-year, and we've seen a similar move in US bond yields as well. The US 10-year is now at about 2.81%, still off its higher levels, but I think we just need to be watchful of these yield moves. They were part of the reason we saw volatility escalate in the period since the Ukrainian invasion. And while we do remain constructive on risk assets over the medium to longer term, there are issues like this in the short term that will probably create some sort of market volatility over the coming weeks. So while positive last week on the outcome for markets, I'm not saying that that's the end of the volatility. I think we are going to see continued focus on inflationary pressures and bond yields and how central banks may or may not react to that.
So much continued choppy waters ahead from what I'm hearing. And of course, the UK celebrating 70 years in the job. Their Queen is having a platinum jubilee this week.
Yeah, it's a funny week for markets. We had a bank holiday in the US yesterday. As I said earlier, the UK markets closed for 2 days later in the week. I think, though, from a market perspective, while trading volumes are going to be very patchy around these holidays, it can't be dismissed that this is a pretty big week in economic data points for markets. As I said, we had the Eurozone inflation earlier today, but we have a big number coming up at the end of the week in the shape of the non-farm payrolls. And again, while the headline number about the amount of jobs added will probably be in focus, the main focal point comes back to the inflation slant is average hourly earnings. They've been reasonably well contained over the last couple of months, but if we did see any spike up in average hourly earnings, that might just bring further pressure on bond yields. So that's the big number that clients should be looking out for. That's out at 1:30 on Friday.
That's brilliant. Thank you so much, David. It's always really great to hear from you and to get your very balanced take on markets. Our next update will be on the 15th of June. I would suggest anybody out there who has got any questions, please do get in touch with your Cantor Fitzgerald broker. And many thanks for your time. We'll see you again in 2 weeks.